In 2025, dividend investors are facing a whirlwind, particularly those chasing aggressive income. YieldMax ETFs are popping up everywhere. MSTY and ULTY have taken over the conversation, not just for their eye-popping payouts, but for a unique strategy. Traditional dividends are struggling to reach even 5%. YieldMax ETFs, however, flaunt unbelievable rates of 70% to over 90%. For cautious investors, these yields seem too good to be true, which makes the story behind MSTY and ULTY particularly fascinating. It's not just about the yields. Explore the strategies and risks that come with these exhilarating, high-yield investments. These funds aren't traditional stock and bond portfolios. They use derivative overlay strategies involving covered calls and synthetic income generation. Their performance is dependent not just on stock direction, but on volatility. Choppy price movements mean more opportunity to squeeze premium out. But these high distributions come at the cost of long-term growth potential. Covered call strategies cap upside, impacting performance in bull runs. The NAV can suffer in flat or declining markets, especially if volatility dries up. For yield-hungry investors, balance is crucial. Can MSTY or ULTY fit into your strategy without replacing sustainable positions? These questions become vital in a year like 2025. MSTY is the older sibling here, attracted a cult-like following for insane yields. Its distribution is just above 90%. That's not a typo. Before dreaming of those dividends, let's break down how that's possible. MSTY isn't your granddad's dividend ETF tracking Dow companies. MSTY is built around MicroStrategy, known for one thing: Bitcoin exposure and wild volatility. Unlike classic covered call funds, MSTY uses synthetic covered calls. MSTY mirrors MicroStrategy's price action by trading derivatives, options, and swaps to capture volatility without touching the shares. It's a play on the ticker, not the company. You're investing because their stock moves, and that movement powers the YieldMax income engine, focusing on short-term volatility rather than long-term value creation. MSTY uses a synthetic covered call strategy to generate income by selling options on Microsoft stock. These options pay premiums, funding monthly distributions. As long as the stock stays within a tradable range, this strategy rakes in income. In ideal volatility periods, this strategy is very effective, thriving in chaotic market conditions. Yield numbers like 70%, 90%, or 120% annualized rates are often discussed, but they can be misleading. These yields are based on the past 12 months' payouts, not future projections. Volatility changes can affect income. Next month's payout is not guaranteed to match last month's. Keep this in mind when considering investments. It can all look like a money-printing miracle in the short term, especially with a stable base stock. But the dark side is just as real. Options cap upside potential. With Microsoft stock rallies hard, MSTY holders don't enjoy the full growth. If Microsoft drops sharply, income may continue, but it's while your principal value erodes. The fund doesn't cushion losses the way some may assume. Distributions can partly come from return of capital. You're not holding MSTY for compounding, as these monthly payouts aren't reinvested automatically. This strategy is about timing and allocation, not core portfolio building. MSTY offers a tantalizing opportunity, but comes with trade-offs that are often glossed over. It's not a substitute for dividend aristocrats. It's a precision income tool, rewarding the informed while punishing the reckless. Use it wisely to unlock serious cash flow. MSTY's net asset value, NAV, its per share value minus fluff, has seen steep drops. This is a classic story. The more aggressively an ETF siphons off income for distribution, the less is left to sustain price or grow principal. Over the last year, MSTY bounced from $46.50 to lows below $18, now hovering nearer $20. That's not stability. In the last year, the share price fell roughly 25%, but total drop from launch is about 5%, indicating a rocky ride. Let's imagine you put $10,000 into MSTY at the start. If you bought in February 2024 at $21 a share, you'd see incredible returns today. 1 year later, with reinvested dividends, your investment would grow to $38,000, a staggering 282% total return. Life-changing, right? Even without reinvestment, you'd have around $27,000, enjoying nearly $18,000 in cash from dividends. These aren't usual slow returns. Now meet ULTY, enhancing the game with weekly payouts and diversification. It's not just about MSTY anymore. ULTY writes synthetic covered calls across 15 to 30 companies known for their volatility: Reddit, Circle, Robinhood, and Tesla. ULTY is unique in the ETF world because it pays out dividends every single week. This is a huge deal for income investors. The yield is still sky high at around 70%, fluctuating with market conditions, just like MSTY. Since switching to weekly payouts in March 2025, ULTY's distributions have ranged from 8 to 12 cents per share. But consistency isn't synonymous with safety. ULTY depends on relentless options trading, so market mood swings can affect it. The shift to weekly payouts seems to have stabilized ULTY's share price, now holding steady around $6. If you'd gone all in on ULTY at launch and reinvested every payout, your position would have grown by a modest 8.9%. Just pulling the dividends for income leaves you almost flat at negative 0.18%. This is after a brutal year for growth stocks. A $10,000 investment with reinvestment would already be up 15% with the new strategy based on March 2025. These products are built for aggressive income seekers who accept the volatility of high-yield investments. For long-term, stable wealth, stick to dividend stalwarts or dogs of the Dow. These YieldMax products offer outsized yields. You can get hypnotized by top-line yields, but markets can calm down and option premiums shrink, causing headline rates to tumble. A sharp drop in NAV can quickly wipe away a year's worth of payouts. Your best protection is diversification. These funds might enhance your income, but they're no replacement for a balanced, long-term strategy. There is a place for these funds, and MSTY and ULTY present game-changing possibilities in analysis. Early in your investing life, reinvesting can multiply your returns rapidly. MSTY's 282% in just over a year proves it. Later in life, dependable cash flow from ULTY can support your income, but stay nimble if the market tilts. These ETFs represent a new era in income investing, challenging traditional norms of 3% yields, emphasizing creativity in income generation. Demand for more income is reshaping the market. The risk is more pronounced, but for savvy investors, these funds offer innovative opportunities. ETFs like MSTY and ULTY redefine income strategies. They provide tools to navigate a market that's ever-evolving. The rules are different. The rewards are substantial, yet the risks have also intensified with these new investment options. It's essential to understand the game, analyze the numbers, and maintain discipline to seize opportunities while managing risk effectively. The key lesson is the same. Yields this high demand respect, strategy, and constant learning. For every moment when they soar, there's always a chance of a tumble. But that's the nature of this beast. It's what makes the future of dividend investing so compelling and honestly, so much fun to watch. So, what are your thoughts on this? Let us know your thoughts in the comments below. And don't forget to like and subscribe for more such content.